Welcome. Every day brings another reminder of the terrible unfairness that besets our country. Here's the latest that leaped out at me. Rolling Stone's report on the fallen, the sharp, sudden decline of America's middle class. In it, Jeff Teach describes a handful of everyday people made homeless, now living out of their cars in church parking lots in Southern California. Once upon a time, one of them, Janice Adkins, had a plant nursery business in Utah that grossed $300,000 annually. But 2 years after the financial meltdown in 2008, sales had dropped by half and the value of her land even more. She tried to refinance, but 4 banks turned her down flat. 4 banks. Makes you wonder about all those big-time bankers at the other end of the scale, the ones who came running to the government and taxpayers for bailouts worth hundreds of billions of dollars, then scooped up big bonuses and perks for themselves and went back to business as usual. And what a business. You've surely been hearing about the newest scandal in banking, centering on Barclays Bank in London and on something called LIBOR. That stands for London Interbank Offered Rate, and it involves a group of bankers who set a daily interest rate affecting trillions of dollars of transactions around the world. Your home mortgage, your college debt, your credit card fees, these could have been affected by LIBOR. It turns out some of those insiders were manipulating the index for their own gain, to make their bank look better off during the financial crisis, to lower their borrowing cost and raise their profits, picking our pockets, lining theirs. The Economist describes it as the rotten heart of finance. Here are some of the emails that have come to light. One banker in on the fix writes another, "Dude, I owe you big time. Come over one day after work and I'm opening a bottle of Bollinger." And another, recruiting a colleague in the fix, wrote, "If you know how to keep a secret, I'll bring you in on it." After being asked to falsify information, an employee writes, "Always happy to help." Another trader jots down in his calendar, "Ask for high 6M fix," to remind himself to play with the numbers the next day. Caught with its hand in the cookie jar, Barclays agreed to pay nearly $500 million in fines to British and American authorities, and as many as 20 other megabanks are now under investigation, including Citicorp and J.P. Morgan Chase. One MIT authority on finance says this dwarfs by orders of magnitude any financial scams in the history of markets. All this explains why I wanted to talk to Sheila Bair. She's a hero to many of us for her long fight for an honest and accountable banking system. After years working on Capitol Hill, at the Treasury Department, the New York Stock Exchange, and the Commodity Futures Trading Commission, she was appointed by President George W. Bush to head the Federal Deposit Insurance Corporation, the FDIC. Now, as senior advisor to the Pew Charitable Trusts, Sheila Bair has just organized a private group of financial experts called the Systemic Risk Council. Among its members, former Fed Chairman Paul Volcker, former Senators Bill Bradley and Alan Simpson, John Reed, once the chairman of Citigroup, and Brooksley Born, the former CFTC chairman, who back in the 1990s accurately predicted an economic meltdown. Its mission, to prevent the banking industry from scuttling the reforms created by the Dodd-Frank Act and hopefully prevent another crash. She has a book coming out in late September about the need for reform called Taking the Bull by the Horns. She's also written 2 books for children about money and entrepreneurship, Rock, Brock and the Saving Shock, and Isabel's Car Wash. Sheila Bair, welcome.
Thank you. Happy to be here.
If you were trying to help some of those young people that you write for understand this business called LIBOR, how would you begin? What's the once upon a time?
I guess I would try to explain to them that when you borrow money, there's something called an interest rate, which is your cost of borrowing money, and there are different mechanisms for setting what that interest rate should be, and one of them is something called LIBOR. And we are discovering now that a lot of unscrupulous people were manipulating that interest rate, apparently to line their own pockets. And that is something that should be severely punished.
Is there one thing in particular you've learned so far that caused you to hold your breath?
Well, this one caught me so hold my breath. I mean, LIBOR always troubled me. There's always been judgment associated with what some people call a fudge factor. There's always been judgment associated with LIBOR, the LIBOR survey. You were supposed to look at various factors, what your recent transactions were, what other transactions are, what the market conditions are. You can use judgment. You don't have to tag it exactly to a transaction. But using judgment and have a potential bias in judgment is profoundly different from open collusion with other banks to lowball or highball the rates to profit. I mean, these emails quite acknowledge that they were trying to manipulate the rate to benefit their trading position. And what's ironic is the trading desk of these banks were probably hurting the part of the bank that does the bread and butter lending, because if they were lowering their interest rate, that would reduce the interest rate on loans, a lot of loans that the lending part of the bank conducts to benefit the trading desk. So they were even hurting themselves internally by doing this.
So there are real world consequences
Yes.
to this. I mean,
There are, absolutely there are.
The New York Times reporting, as unemployment climbed and tax revenue fell, the city of Baltimore laid off employees and cut services in the midst of the financial crisis. Its leaders now say the city's troubles were aggravated by bankers' manipulation of a key interest rate linked to hundreds of millions of dollars the city had borrowed. So there are real world.
There are absolutely real world consequences to this. There are counterparties to all these swap transactions, which is what they were trying to manipulate. And those counterparties were being hurt by it, absolutely. It's shocking. It should be punished very severely, and I think there probably is going to be more information coming out about it before. So I think it's just starting. I don't think it's over.
You say they should be punished, but the Justice Department the other day, in this settlement with Barclays, let the bank off if it paid the fine. So that doesn't suggest severe punishment, does it?
You know, I think another thing that troubles me about all the enforcement actions that are brought, and there haven't been enough of them, but they generally just they tag the shareholders, right? So Barclays Bank, the shareholders ultimately pay this. There should be punishment of these traders and higher up in management, depending on how high it went. There should be not only clawbacks of compensation, but severe civil monetary penalties against the individual traders. Make them pay out of their own pocket. It's not much of a deterrent for them if their bank is paying for it, their consequences of their mistakes, not them personally. So I hope there is more of that. There should certainly be more civil actions against the individuals, and there may be criminal activity involved here too.
Let me play for you something said the other day by the former regulator Bill Black, whom you may know. He's a hawk on holding banks, bringing banks to the bar of judgment. Take a listen.
What you've just seen is a cartel in operation which did exist and did distort LIBOR for the benefit of the largest banks in the cartel. It is the largest rigging of prices in the history of the world by many orders of magnitude.
That's quite an indictment. Barclays and possibly, he says, a dozen other banks operated as a price-fixing cartel for their own financial benefit. What does that tell us about our financial system?
Well, I don't think we know all the facts yet, but certainly we do know that from 2005 to 2008 there were documented instances of Barclays, according to Barclays traders, colluding with other banks to influence the LIBOR rate. I think just that by itself shows a culture of greed, of people feeling they're above the law, above ethical standards, basically justifying anything to make a buck. And I don't want the government setting interest rates. I don't want that at all. But I do want government regulation of how the market sets interest rates. And there were red flags about LIBOR back in 2008. And then the simple fix would have been to say that if you submit a rate to LIBOR, it has to be based on an actual transaction, that you actually borrowed money at that rate, not your best guess, today, what I'm going to pay. Because the process itself opened itself up to abuse, and then it completely spiraled out of control. So that, that's one of the many things that was frustrating about this crisis. So many of the problems, the fixes were so obvious, and we just didn't have the political will and fortitude to just tell the banks, you've got to stop doing it this way. You've got to, start basing this on an actual transaction. The fix was not hard. It was just never done.